Look at this chart. The white line traces the stock market's decline leading into the 2008 financial crisis. Now, let's layer the market trajectory for 2026 over it. The path today tracks almost perfectly with the period right before trillions of dollars vanished from the global economy. Much of the market is currently focused on the momentum of the artificial intelligence boom. Companies are seeing their valuations surge simply by associating with the tech, creating a level of excitement that often obscures the underlying economic data. Behind the scenes, many economists are analyzing these trends with increasing concern. They see a system currently resting on a combination of high growth expectations and significant levels of consumer debt. To anticipate how this cycle might end, we have to break down the specific sequence of the 2008 collapse to see which gears are beginning to turn again. Recognizing the life cycle of these financial shifts isn't about predicting a specific date. It is a tool for identifying systemic risks early enough to move personal wealth out of their path. In 2007, banks issued thousands of unchecked loans to buyers who lacked stable income or assets. This housing boom was fueled by the assumption that property values would rise indefinitely, making the quality of the individual borrower seem irrelevant. Wall Street repackaged these risky mortgages into collateralized debt obligations, or CDOs. By bundling these loans, they convinced investors they were 100% safe. This created an illusion of massive growth, but the entire structure rested on debt the homeowners simply couldn't afford. Today, tech giants are spending billions of dollars building out AI infrastructure, filling vast data centers with specialized microchips. They are betting heavily that this technology will fundamentally increase the productivity of the entire economy. Market valuations are currently based on the assumption that AI will generate massive, scalable returns in a very short window. However, many businesses are discovering that while these tools are capable, they haven't yet translated into the trillions of dollars in new profit required to support current stock prices. Catastrophic bubbles typically expand in this specific space, the widening gap between what the market expects a technology to do and what it is actually earning in the real world. While Wall Street focuses its attention purely on tech, the actual underlying health of the economy is determined entirely by Main Street. In 2008, the system began to fail when consumers simply ran out of money to pay their mortgages. The current data shows that consumers are reaching a breaking point. Millions are surviving on record-high credit card balances and short-term buy-now-pay-later loans just to cover their monthly obligations. Years of compounding inflation have eroded purchasing power. Basic necessities like groceries, rent, and fuel now require significantly more capital than they did just a few years ago, leaving very little room for error in a household budget. Default rates on auto loans and credit cards are now accelerating at a pace not seen since the 2008 crisis. Everyday people are now beginning to fall significantly behind on their payments, simply because the rising cost of living completely outpaces their stagnant wages. With interest rates at 20-year highs, carrying this debt is becoming more expensive every month. The balances are growing faster than most families can pay them down. Since the global economy relies on consumer spending, the entire engine loses its power when Main Street is forced to stop spending because of the weight of its debt. When those individual defaults reached a critical mass in 2008, the pain moved up the chain. It eventually reached the largest financial institutions, forcing companies like Lehman Brothers into bankruptcy in a matter of days. The Federal Reserve is the institution responsible for managing these crises, but their current options are limited. They are in a liquidity trap. If they cut rates to help consumers, they risk devaluing the dollar and causing a price surge. If they keep rates high to fight inflation, smaller regional banks will continue to break under the pressure. During the last major crisis, the government rapidly injected trillions of dollars into the economy to artificially save the entire financial system. Today, the safety nets are thinner. Repeating that move in this high inflation environment risks further eroding the currency's value and accelerating the cost of living crisis. History rarely repeats its mistakes exactly, but the correction between market hype and consumer reality is a recurring pattern. To protect yourself, the first priority is to pay down high-interest consumer debt. Reducing what you owe before credit markets tighten further is the best way to maintain your flexibility. Second, consider diversifying out of the most over-leveraged tech sectors. Moving capital into assets with consistent, tangible cash flow provides a more stable foundation if the AI bubble begins to deflate. Holding a cash reserve is a strategic advantage during a market downturn. It provides the liquidity needed to purchase high-quality assets when their prices are suppressed. Recognizing the echoes of 2008 isn't a reason to panic. It is an early warning system that allows you to position your wealth defensively before the market makes the move for you.